Hi, I'm Shae Russell, and joining me live right now is Nomi Prins from her home in LA. Sorry about that, and I'm in Melbourne. Nomi, thank you for joining me today.
Thank you very much for having me join you.
All right, I'll be honest, we've gone live and I flubbered my introduction there. So let me do a take two for everybody listening. Now, Nomi, you are a prolific author. You've written 7 books. Two of the more recent ones that spring to mind are All the President's Bankers. Heck of a headline, very jealous. I didn't write that one myself. And Collusion, How Central Bankers Rig the World. Now, we are here to talk all things today about central bankers, volatility, the disconnect, and real people and their savings. Nomi, let's kick it off today with central bank madness. Is what the Federal Reserve Bank gone and done, is that necessary, or is it really just a waste of Americans' money?
Well, I think that the Fed in particular, as the sort of mother central bank in the world, has really overstepped most of its boundaries since the financial crisis of 2008 began. So the whole idea of manufacturing money, fabricating money in order to go into the financial system back then, it went mostly into banks and then sort of into markets, but it was under the guise of, but we're going to help the economy. And there was like no measure where you could actually see the economy doing as well as the markets were doing. And that's because the money that the Fed was creating and the rates that they were dropping so low was just allowing kind of financial players to get involved in the markets, big banks, hedge funds, private equity funds, and so forth, to just have more to use to get into financial assets, which for them was great. And for people that were participating in those markets was great. But, you know, there was this sort of lack of proportion between then and what happened up through the pandemic. Now, at the end of last year, actually the middle of 2019, the Fed already started to go back into its mode of sort of creating more money or doing what they call quantitative easing, but they decided that that wasn't what it was. They were just providing new money because the banks do these short-term loans between themselves and their corporate clients, and they felt they weren't confident enough to do that, and so they wanted the Fed to back them. And that's where you start to have problems. You know, we've had 10, 11, almost 12 years of the Fed backing everything that could potentially go wrong financially under the guise of helping the economy, but for the most part, proportionally going to the financial economy. So now you get a virus, a pandemic, and you have shutdowns and you have lockdowns and you have people not only kicked out of their jobs, but unable to physically even enter the premises where they used to work. And you have a major, major problem. And so the Fed coming in and being a part of the solution could have been useful, but the reality is that the people that received any money while they weren't working or received loans from some of the government programs in the US and different ones throughout the world that were actually done better than what the US did, because they went more directly to employees and to people and sort of more widespread, didn't happen because of the reliance on the Fed. And so everybody in Washington is talking about how great the Fed is and how without them, things would have been a lot worse. But if you actually follow the money, most of the money that the Fed has created, and they've since doubled the size of their balance sheet in the last, well, basically since last August, but mostly since the pandemic, has not gone to real people. It has gone to increased debt of corporations. It has gone to the financial markets, which are now close to record highs. The NASDAQ's at record highs. The Dow is getting back to where it was. And the real economy just doesn't have that chance. It doesn't have that shot. So the Fed actually creates a distortion. I call it a permanent distortion because the Fed's never going to go back from no limit. Now, Jerome Powell, stuck his head out and said, no limit, no limit, no limit, which was something that European Central Bank leader Mario Draghi kind of said back a number of years ago. But like they mean this stuff. And so as long as there's no limit to the amount of money that can be created, there's no limit to the amount of bubbles it'll create or the crises that'll either happen or become worse because of those bubbles.
Well, that's an interesting point that you bring up by saying that they've created, the no limit to central banking. Where do they go from here? Because they've come to try and solve one crisis, really after relatively speaking, a fresh crisis. If you go to no limit, what's the end game?
Well, I don't think any of them have an exit plan. Because even when the Fed tried to, and I saw this at the end of Collusion, there is no exit plan. And so the next crisis will simply be piling on to the same premises and the same activities as the last crisis, which is what we're dealing with. But by having no limit, you're also creating a market, a financial economy that can do whatever it wants to do, because whatever crisis comes about, whether it's from something external like a pandemic, or something internal like a whole bunch of corporate loans going default, and or the derivatives associated with them as well, and so forth, they know they're going to get effectively bailed out. And it's not even going to be called a bailout. It's going to be called stimulus or intervention or monetary policy or quantitative easing, or lots of different names for bailout from respect to the Fed. So you can't go back from no limit. If you can grow your book, i.e. what the Fed did, and the ECB is doing it, other central banks around the world are cutting rates as close as they can to zero, depending on where they've started from. You can't really go to the next crisis and not do it again. We're this like totally new kind of surrealism of monetary policy where they can just create whatever. And as long as there is an effect, and in this case there was, markets went up, markets went back up, they can point to it as being the thing that helped the economy.
Now, this is what you actually try and help your subscribers and your customers understand, is the difference between the financial economy and the real economy, because you pointed them out that they're two different things. So how are, ordinary investors, how are they supposed to invest with the Fed?
Well, that's the whole thing. There's two schools of thought. There's don't fight the Fed, and then there's not. Yeah. And the reality is, if we're looking at things that drive the market, the Fed is one of the major things that not only has driven the market since the pandemic, it's driven the market since the financial crisis. And a bit before that. I mean, really since the sort of Alan Greenspan pre-financial crisis period where, we were having corporate corruption going on with Enron, with WorldCom, with the banks and all of that. And so there was a little bit of help then as well, but nothing like what we got in after the financial crisis. So talking to real people or looking at real investments, because most of them know that they may not be doing as well, or their neighbors may not be doing as well, or the local store that can't open, or the local restaurant that can't open, or the local nail salon or hair salon or so forth. Like all of these things in this case right now are closed. And as a result of that, some people who had money kind of saved up, want to know what to do with that in order to avoid potentially being part of the next crisis or another fallout in the market. So that's one way to sort of hedge against the difference between what is really going on the ground and sort of the patheticness and the tragedy of what's going on the ground with respect to jobs, with respect to businesses, with respect to just certainty being gone. And what they can do instead. And so when we look at recommending investments, we do them through the options markets because they're a way to take positions in the market without necessarily putting all your money in. There are sort of quantitative ways, the way we recommend them, of being sure of what your risk is, as well as what your potential upside can be. And in that process, we look for either company names or commodities or commodity indices or whatever it might be that best represent the changes that have been happening in the economy. Whether that is, we had a trade on for a while as a pandemic was unfolding, which was a put on Wynn casinos, and which is still doing badly. But one of the reasons that we looked at that trade in the United States was because we were looking at what was happening in Macau when China first closed and when Macau closed and what happened when they opened up, and were there people going back there, and what was the general tenor on the ground sort of throughout the world. And then we sort of narrow that down to companies with parameters for recommendations. We do a similar thing, for example, recently with silver. We took a look at the behavior of what happened in the wake of the financial crisis of 2008 with the Fed, and how when they grew their book, when they started quantitative easing to help the banks back then, a couple of things happened. Gold escalated in price, and silver did. It subsequently came back down, but there was a point where there was a relationship between the Fed's book growing and these commodities growing. So in this particular time, we took a look at gold, we took a look at silver, and we decided that silver had the best potential upside, and also from the standpoint of just sheer price. That, if you're a human with, a reasonable income, or you just lost half of the income in your household or whatever, and you want to preserve and protect and also grow your wealth, it's easier to physically buy, for example, an ounce of silver than it is to buy an ounce of gold. So if you look at the fact that the real economy is suffering, but people in it also want to find ways to protect and grow some of what they have for the future, especially with this major crisis, that's an easier place to do it than potentially gold. Not to say we didn't think there was upside to gold, but just as a relationship between the two. So recently we had recommended that with all of the reasons behind that. We've also talked about real estate. We're seeing right now in the real economy, and the sort of migration from urban centers to living in the suburbs again, sort of like back in the 50s and 60s, and people moved out to the suburbs, because then they had cars, they had highways they could get away from, in the United States anyway, cities, and sort of have space. And we're seeing kind of that same thing happening because of the pandemic. People are like, well, we can work from home. The cities are expensive anyway. They're less safe anyway if we have a pandemic zooming through them in and out, because people are just in more closer quarters. So why not leave? And so we've looked at trades, for example, that sort of mirror that pattern as well. So we're looking at that distortion and using it as a way to marry to what the Fed's doing, to what real people are doing in all the types of recommendations that we put out.
So basically, I really like your perspective there. It's not about, investing with the Fed. It's about looking at, okay, this is what the Fed or your central bank is doing, and then what's happening in the circles around it, and how can we help other people benefit from that information and that shift in the real economy.
Right.
Now, one thing that's been a little bit fascinating watching from Australia is how the US market just seemed to bounce right higher out of that March bottom. It felt from watching from a distance that it came out of nowhere. But given your experience with central banks, did it surprise you?
No, not at all. Because if you have about $3 trillion worth of central bank money being created in like 3 months, it tends to have an impact. The most access to that money really just goes through the banking system. So it's a little bit ironic that at the moment that the bank sector from a stock perspective isn't doing as well as some of the other sectors that zoomed up. But the reality is everything kind of goes through them in some manner, whether it's borrowing of money that corporations were doing because they needed to figure out a way to stay solvent because they weren't able to operate. Or whether it was hedge funds or private equity funds that actually did have cash on the side and do anyway, but can borrow more of it at cheaper levels because the Fed cut rates by 100 basis points in a minute. Yep. All of that makes money cheaper. And money, when it's created really quickly and really cheaply, it doesn't go to places where it takes a long time for it to get a return on itself. The easiest place to go is the stock market, regardless of what's happening on the outside. You just have this pool of money that for various reasons has been catalyzed. And the fastest avenue for that money is the stock market. We've also had a large growth in the corporate bond market. I mean, the issuance of bonds in the last quarter is almost twice what it was in the same quarter of last year. So there's a lot of debt, there's a lot of equity sort of bubbles that have been happening, but mostly that's because you just blown a whole bunch of money into the system, and money doesn't want to like necessarily wait to go to like the corner bar and figure out how people are going to get their jobs back, or how their home deliveries are going to go because they can't open their doors. It does a little bit through government programs, but for the most part that's slow. Yep. What's fast is to go into the market and sort of have this perpetual push of itself, and that's kind of why we were so far ahead in terms of the stock market appreciation, which ultimately has happened everywhere, but why it was so fast in the United States, because we just created the most amount of money for the financial system the most quickly.
So with this $3 trillion that the Fed's basically started throwing out, and I'm going to focus on the Fed because especially from an Australian point of view, it's great to get somebody who really understands how the Fed works. With this $3 trillion that we've just seen the Fed throw into the markets, how is that helping the real economy if the financial sector's just going through the roof right now?
Well, that's a really good question, and this is a debate with like a lot of economists that feel that, well, if that money wasn't available to back certain lending programs that the Fed had, some of which do connect into the Main Street economy, then everything would have fallen apart. And I look at it like, well, first of all, then maybe we would have had to have more sort of government help, more direct help. Maybe there should have been more thinking in terms of how we, sort of help people for a longer period get through this, as opposed to it going proportionately more to the top of the financial system versus the sort of foundation of the economy. And that's kind of that's kind of the problem, is that it was necessary to help all levels of the economy, because all levels of the economy were hurting. And so some of these programs that combine what was going on with the Treasury Department and the government and what was going on with respect to the Federal Reserve were necessary, but in a different way. It was not necessary to give a disproportionate large amount of money to the financial system and to the larger corporations versus helping people stay on payroll. And through both the large and mid and small businesses of the economy. Like, so for example, many small businesses could have gotten a portion of payment protection program loans from the government. That was a thing. And also some of the loans that were made through that program are supposed to be bought by a Main Street program that the Fed has opened to help Main Street. Which that actually does is it buys loans that banks made to Main Street for more money than they're probably worth. So the banks have no risk, and the Fed basically backs banking activity, but the banks are still choosing who they lend to and who they don't lend to. So if you're someone who doesn't know how to fill out forms, you don't have your own accountant in your small business, you're an individual selling fruit on a corner, or you have your own nail salon with a bunch of, workers that effectively do that and aren't necessarily financial whizzes, or you're not attached to a large bank, you weren't going to get any of this money. And so it looks like so much, but when you actually go through it, and it does benefit some people who aren't bankers and some people who don't run corporations, absolutely. But on a sort of overall basis, less proportionately of them than of the financial assets, which is just indicative of, all you have to do is look at the market. And it goes back to what you were saying before. The market's getting the money.
Yeah. So arguably some of what was meant to be goodwill hasn't quite filtered through to the Main Street because they lack the financial savvy to be able to access these programs.
Well, that, yes. And also, that wasn't part of the strategy of providing this money. So for example, a lot of it went to the biggest banks. Logically, it makes sense. The biggest banks have the most amount of customers. They might be small businesses. Therefore, you're spreading. But in reality, what the banks did was they basically lent money to their largest small businesses because that's how they could make the most money. And they didn't necessarily help those who might be smaller small businesses or new people coming in and saying, hey, I don't have an account with Chase, but you're on my corner and I have a business that's closed like next to you, literally physically next to you in some of these small towns. Can I apply for one of these loans? And there would be no help because they wouldn't be a customer of the bank. And so they would have to become a customer of the bank. They would have to go through that paperwork. That would have to be approved. Then they'd have to go through, there's just a lot of chain of events that, in the moments of those emergencies and closures don't really help. And so if the government had done something differently, like say, give a proportionate amount to local banks or banks that were committed to helping local economies everywhere. So, you spread out sort of local or smaller middle type of towns. And you say, all right, well, you have a community bank, you have a bunch of people there that can't work because the bank's closed because we just closed everything. However, can they give us a list of who's in the community and who might actually need loans, and can we repurpose them? Because it doesn't take that long to help those people apply or to provide more money for them to. There was just no planning in terms of how to quickly, and yes, there was an emergency, but just how to quickly get that money to where it was professed to be going.
Now, I'm going to step away from the Fed for a moment. We may end up back on there. You and I first met briefly when we were back in Berlin, I think in 2016. So it was a while ago now. And one of the comments we were talking about time was banking risk back then. And I threw a line out there saying, you know, the Australian banks, are they on your radar? And your answer was, well, they're not problematic, so no. Now, obviously a lot has changed in those short 4 years.
Right.
Let's talk about banking risk, not just in the US, but how is the global banking risk chain? Because we are more intertwined than ever before.
Well, that's right. Well, that's the basis. And one of the reasons for that is that there has been the supply. It's not just from the Fed. It's from Australia. It's from the ECB. It's from Brazil. It's from the People's Bank of China. You do have external sort of support for the banking industry that allows the banking industry to take on more risk. So even when they say that they have enough funding available to sort of cover their risk, the reality is, well, first of all, some of it's not based on like legit accounting, but also some of it's just based on this idea that has now been proven true. But even when there were scandals in the Australian banks and just in general throughout the world, Deutsche Bank falling apart, even though it had all the support after the financial crisis and so forth, you have these banks that had all this help. And so what that does is, first of all, it provides a sort of external source of liquidity or money that allows them to be a little less careful because they have sort of more in the bank that shows that if there was an emergency, they could use it. They don't have to sort of show themselves to be risk averse under really stressful scenarios. In the US, there was some stress testing that came out of the financial crisis, but literally none of it even remotely touched the crisis levels of the pandemic. Now, one could say, well, nobody knew there was going to be a pandemic. Yeah, but it's not rocket science to like multiply your unemployment by a couple times and sort of just basically think possibility and just show what would happen and just be prepared. And none of the banks really in the world have been doing this, particularly since the financial crisis. And yet they've been able to show that they have more money available to fight a crisis because of central bank movements.
Are these stress tests that they put out there, are they just farcical or are they just PR exercises, or is there any value in the stress test?
Well, not if there's an actual stressful like situation. I think I wrote this in a piece or maybe a book, I don't know, but it's like the stress tests are only as good as, we have SAT tests here, we basically have school tests and stuff where there's questions to get into various schools and stuff. And it would be like you're creating your own question and you're answering your own question. That's how the stress tests work. They're involved in creating them, the banks. So it's like, it's not rocket science to be able to pass the test that you created. Like it would be bad if you couldn't. So
that's a really good answer.
It just, so that's one of the problems. And certainly for a real crisis, those tests are completely meaningless.
Okay, now let's talk corporate bonds, because there's been some fascinating movements. Again, this is very much an outside looking in perspective. I mean, we've seen shareholders driving the price of Hertz up, for example, even though the company's borderline bankrupt or is bankrupt, but yet they're able to raise $1 billion in the corporate bond market. Is that correct?
Yeah, or a little bit more than that, right?
Yeah.
So
there's zombie companies raising money from the markets. How is that possible? Doesn't that defy logic?
Well, you would think that companies should be able to repay their debts by sheerly operating over some period of time. You can have a bad quarter, but like just in general, if you're a viable company anyway, or not a zombie company, in which case you actually aren't making enough of a profit to be able to pay the interest on your debt, not even your debt, like the interest on your debt. That's what we're talking about, the zombie company. You're kind of there. It's like, why bother, right? I mean, now sometimes it's because companies are in growth scenarios. There's reasons why debt's taken on to grow into something else, and companies, individuals use debt for positive purposes as well. But when your business model is to just get whatever debt you can get as cheaply as you can get it and just pass it on forever without trying to figure out how the rest of your business is going to support it, that's when we run into problems. And that's kind of why we've had almost a doubling of raising debt in the last quarter versus last quarter, versus last year, the same quarter, because money is so cheap again. And so if not for real people, but for these corporations and for these banks. So if you can borrow at 0 or 0.5% or 1% or 3% when it used to be double, triple, or whatever more than that, to borrow, like you're going to do that all day long. That's basically what the Treasury Department does in the US. It's what governments are doing as well. They're just increasing their debt because it's cheap. And it makes you lazy. It makes a company lazy. It makes a government lazy. You know, you just assume that you can borrow your way out of the present. And again, sometimes you may need to borrow more to move from the present because you have a crisis or something else to get through it, but you don't have a plan on the other side to repay it.
Look, we're probably drawing near the end of our time, but how does this end for companies? Like, are we talking, you know, obviously bubbles can run on longer than, you know, people can imagine, but how long can the central bank continue to prop everything up with no limits? And how long can markets continue to operate on the idea that as long as the Fed backs it, everything will be okay?
Well, I think markets believe that. And so they do absolutely operate on that idea. The Fed, other central banks will back them because the Fed was very clear that that's what would happen. Now we have a crisis, so the Fed says, well, as long as inflation's under 2%, we'll do it. But I mean, the thing is, they just, since the last crisis, they continue to move their boundaries as to when they'll help and when they won't. They will help. So the issue is, what other things come into the markets from real economic strife, from trade wars, from another leg of a pandemic, from like Martians, like whatever it is that comes in from the outside, that could basically move things around and create volatility or uncertainty or negativity or major crises, major financial drops where defaults happen. Like right now, we're looking at a major swath of the energy sector is defaulting. And what's happening is that the companies that had more support to begin with, that can access more money more cheaply to begin with, are just buying all the other companies. And so what we're seeing right now is a consolidation, a lot of mergers and acquisitions and hunting going on in terms of those that can borrow cheaply or that can ultimately buy their stock with that borrowed money in share buybacks or whatever, and use that as currency to buy more companies, whereas other ones will default more. But if there is a situation where there's more defaults happening than mergers happening, or more economic or other external factors dragging the market down, than money coming in, then obviously we'll have a negative turn in the market. And we're going to have a lot of volatility between those occasions, you know, the Fed pumping money in with other central banks and all these other things happening that are more sort of real, doing a push-pull on the markets. But I mean, that can go on for a very long time.
Do you know, it's funny, I was about to ask you how long can volatility last, but it sounds like the volatility will last longer than I can keep up.
Well, yeah, because volatility is today, and has been in general, but particularly since the financial crisis, you know, this thing that's stuck and this thing that grows when what's happening in the real world and what's happening in the financial world or central bank world are just at odds. If the Fed was doing enough to always keep the markets up, then we wouldn't have volatility in the markets. So that there is a little bit of a give back that happens because real factors, real events occur, and the market has to digest them. And sometimes the market doesn't even care about them. They just bet as to where the money should be moved around because of them. But all of that creates volatility.
Now, before we wrap up, my final question for today is, where's the blind spot for investors? What's the pocket that the mainstream's not drawing attention to, or what you believe, you know, without giving away any company names or proprietary secrets of anything of kind, but there's always a blind spot in the market. And where do you think just retail investors should be looking to help try and navigate this very turbulent market that we're seeing?
Well, I think the general gap is the behavior change that people are not just having now because it's imposed upon them, but that will remain after, I don't know after we're done with this pandemic, but as time moves forward, the things that will remain, the sort of the propensity to for now or for the next number of years, move away from really clustered places into more stay-at-home type of work environments. Telehealth type of services where people have become accustomed more to talking and will, I think, to virtual, well, not virtual, real doctors, but through their computers versus going into them, because a lot of them have only taken COVID patients or they're closed for other reasons or whatever. But these behavior changes, I think these are the pockets that will do well regardless of how long it takes for the pandemic to go away or for the economy to recover, that are just going to be permanent changes in our behavior. And I think that's where there's ongoing value, because I think it's going to be a real trend of more saving type of behavior, more discerning in terms of what items are bought, more discerning in terms of what's useful to be doing from your home, or what you need to do from your home that you can't do outside. And again, the relocation, if it's available, into different sorts of suburban versus urban environments.
I lied. It turns out I do have one final question. I did say I'd do that. So you just talked about the behaviour change as probably being, the big shift out of this crisis this time around, or pandemic, whatever we're calling it. Is that what makes this one different from the last crisis? Because we're arguably, 12 years on from the last crisis, 13 years depending on when you count. Is the behaviour change what is the identifying factor that's the difference this time? Or are we more complacent this time because we have faith in central banks?
I think both of those things are actually the case. The markets and the banks, the financial system, the debt that's going to continue to accumulate and hit record after record after record, that's more reliant on this no limit policy of the Federal Reserve and the distortion that then creates in the financial markets for financial assets. What remains of behavior shifts around the world, that's where there's this other side of the economy that's both going to hurt in places, and that's also going to emerge with new types of focuses that I think relate more towards not even necessarily just staying at home, but the idea of being able to have workplaces that are not necessarily clustered in an office or clustered in a particular building. Now, what that means for people that didn't have that didn't work at offices or didn't have to go somewhere, like small restaurants, hair places, nail places, clothing places, and that kind of thing, I think we're going to just continue to see that shift into sort of internet stuff. I think it's going to hurt local businesses, but I also think there's going to be a resurgence, ultimately, those local businesses as these urban people sort of move into the smaller towns. So I think we're in a multi-year cycle, and that's not knowing what happens specifically with the pandemic. So I do think that's going to play out for a number of years.
Look, that's incredible insights. Nomi, thank you very much for joining me today. I love talking to you as always. We don't get to do it enough.
I know.
But thank you very much for joining me today. Now, before you run away, where can people catch you over the next couple of days? Because you're involved in quite a few things over the Sprott Symposium.
Yes, I know, and I should know all the timings, but at the Sprott Symposium, I do have a talk, a keynote talk that will speak about the pandemic and central banks and investment choices and crisis and confidence and everything else at, I believe, 2:15 Vancouver time, so whatever that is for everybody else. There's also a Q&A in the morning that I actually did tape with Albert that will be opening part of the 8 a.m. or something like that, Vancouver time, part of the conference. Then there's a wine tasting, which I think anyone who's involved in that conference or participating can potentially participate in, and another Q&A following that. So bunch of stuff.
You have a full dance card.
Wine's included. So the good thing is there's wine in the day. So that's a good thing.
Well, look, from somebody in Australia, I can tell you we're fans of day drinking. All right, Nomi, we didn't quite get to the squirrel part of our chat today, but I don't want to take up any more of your time. Thank you once again for joining me at the Sprott Symposium. And gee, I hope we get to do this in person next year.
I do too. Take care.
All right, thanks. Bye.